It feels like life is getting back to normal. We've got a manager over from New York. Last time I filmed him, we had to do it by Zoom. It's great to do this one in person. He's a really, really influential guy in the small and mid-cap space. Let's go take a look. Welcome back to Vantage. It feels like things are back to normal. We've got someone over from New York. Randy Barron, welcome back. So what brings you to London?
I'll be speaking at the stock exchange later today. To your point that events are back, I'll be giving a bit of a New York perspective on UK investing.
That's great. And look, for those who missed our last video, it'd be worth us just covering off just a quick overview of Pinnacle, the fund that you run. Just give us a quick snapshot of that.
So Pinnacle Associates is a New York-based stock pick institution. We are long-only managers, so no shorting, no derivatives, no leverage. We manage about $8 billion in total, and I'm responsible for all of our international products. The strategy that I'll be speaking about today is our international small cap, which about 40% of that book is UK.
Excellent. You're very modest. It's been a great fund, the small cap fund, etc. You've had a few years, etc., where it's done exceptionally well. This year, it's a tough start to the year, right? So look,
the year's not over yet.
No, I know. So what's driving? What's driving the tough start to the year, and more importantly, how are you reacting to it?
Well, that's a complicated conversation. It feels in many ways like everything is down. I mean, the proverbial baby has been thrown out with the bathwater. And so it seems in this general market retrenchment for good reasons. You know, as we talked about before, no one saw Russia-Ukraine kind of escalating the way it did, right? The consumer is still strong, but these macro events, you know, the question, will China take Taiwan? These kind of overarching fears have really driven the market down. And I think that that's unfortunate in the short term, but also really present an opportunity for stock pickers in the long term, because you have a lot of names right now that are trading at 30 to 50% down when they were 3 or 4 months ago. And over time, you know, quality companies will really transcend.
Okay, and there's a hint in terms of how you're reacting to it, which is that you're still looking for interesting ideas. I mean, you mentioned in your last newsletter that growth is being sold off, and that you tend to get overshoots both on the way up and on the way down. You still convinced around growth stocks?
So we're known as growth managers, but what's really interesting about this year, 2022, is and I'll talk about this tonight at the exchange, I've been focusing a lot on the question of this dichotomy between value and growth investing, right? And it seems to me that we can buy today a lot of growth stocks kind of for value prices, big margins of safety. And what's fascinating in our business, you know, when you're going to get an allocation of funds, you need to check the box. Are you a growth manager, a value manager, a GARP manager, distressed, whatever it is? And it dawns on me that the tenets, that the growth versus value dichotomy is maybe a false dichotomy, and I'll give you some examples. You know, traditional value investor has 4 or 5 tenets. The first is when I own a certificate, a share, I'm owning an actual stake in a business. And once I look at it that way, to say I'm owning a business versus a trading piece of paper, the second tenet becomes I can determine true worth versus price. I use fundamentals, that's the third tenet, to determine that true worth. But the kind of core 4th and 5th points are when there's a big divergence between share price and intrinsic value or true worth, whatever you want to call it, that's when opportunity strikes. And then, of course, the most important thing for times like this, how do you have the emotional fortitude to step in at these moments?
Yeah.
And so with us, you know, we know the companies that we own very well. And it's funny, I talked about in that newsletter, the names we owned in 2019 before COVID were the names we owned in COVID, or the names we own today out of COVID, with the exception of some takeouts and M&A. And so by knowing those companies and knowing those managements really well, like I said, we're able now to buy these huge growth names at really distressed prices. So we've been adding to our positions. That's how we're handling this year.
Okay, so you trust what you know, etc. And yeah, I guess it's the tenets of a good business is it'll stand the test of time. So it's encouraging that you've had longevity with those names. So talk me through a couple of examples. You said, you hinted at the fact that, you're re-examining names, you're looking at them again at the sort of prices today. Walk me through a couple of examples of things you've looked at.
Sure. So
Yep.
we're known, our claim to fame, for good or ill, currently for ill, is we were the first U.S. investor in Renalytix. Renalytix is the poster boy for AIM investing here. It was a unicorn with over $1 billion valuation, did a cross-listing to the NASDAQ. We were here from the beginning. And when I look at healthcare in general, the XBI, which is the healthcare portion of the S&P, has retrenched to 2017 levels. So translated, that means no innovation or even negative value has been assigned to half a decade of progress. And you look at kind of what's happened in that time, SGRT inhibitors for kidney, CAR-T for heart. I mean, truly seismic shifts that's being assigned negative value in the market. So for me, as long as these companies have enough cash, in the case of Renalytix, they did a raise a month or two ago that we participated in, $30 million raise. They have enough cash to make it through 2 years now. And by the way, they could ratchet it back even further if they had to. So I don't need to worry whether these companies are still going to be there. It's more about, to our original tenant, we're looking for impactful companies that are going to make a difference in the world over time. And for example, in Renalytix, they're addressing chronic kidney disease. There's no better solution. So if we're going to have a solution to essentially obesity and all the things that come with it, Renalytix and that type of diagnostic is going to be a part of it. There's other companies that are a little less market specific. They're a little more agnostic. So Nanoco, for example, which is a tiny company that does quantum dots out of Manchester, Runcorn. That's an example that last week they won a lawsuit, or they won the first phase of a lawsuit against Samsung. So that stock was up 40% last week. And so the point is, there are certain gems that when you go through are still finding opportunities and helping us weather the storm.
Excellent. We've just come through, and we're at the tail end of it now, but earnings season is almost through. Were there any broad themes that you sort of picked up as we went through the last reporting season?
Yeah, the biggest takeaway to me is, despite the looming thunderclouds of recession that are around us on the horizon, the consumer is still very strong. 60% of GDP in the U.S. is consumer. The consumer has much more savings than they did before COVID. The consumer is still spending. And while certainly there are some concerns on the horizon, like the price of petrol or gasoline at the tank, the truth is the consumer is in much better shape today. So I'm in the camp that we're not going to have a full-fledged recession. The consumer is going to bolster things. And while inflation is a real risk, the consumer is going to see us through.
Excellent. Okay. So you talked about the fact that you 40% of your portfolio is sort of UK exposed. The UK actually started having a very strong start to this year. It was outperforming a lot of regions, and it was for a number of years actually had been underperforming. Still compelling today? I mean, you've seen the sell-off, so I guess the question is the UK still compelling? What attracts you to the UK?
Well, it's a relative thing.
Yeah.
A relative sell-off. And when you look at the alligator mouth, or how the U.S. has done in the 5 or 6 years since Brexit versus the FTSE, I mean, it's rough numbers. But going into this year, FTSE was up 10 or 15%, and the S&P had doubled, right? And so now we're seeing a bit of a retrenchment, to your point, but we have less to fall. I'm in the camp that, despite the fact that UK investing was a bit of a pariah in the wake of Brexit, I have this great phrase that even mushrooms grow in the dark, and we can find these things. And by the way, I'm looking. We were talking earlier. I met with the former chairman of EKF Diagnostics. We don't own a position, but I'm here visiting companies and kind of seeing where the opportunities are. And I have to say, I'm pretty enthused with what I'm seeing.
Yeah, that's great. So let's just wrap up. You're sticking with what you know. You don't think that the outlook is perhaps as bearish as the sort of market's indicating today. You think that there's some gems out there, some really interesting companies that you can sort of enter into at, what I think in the long term will be extraordinary valuations, actually, in some cases.
People forget, price only matters if you're selling. If you book the gain or loss, that's the moment it matters. But I'm an equity stock picker, and I'm here to tell you, Neil, the future is good.
Yeah, no, thank you. And, what I guess, for the companies that you're working with, everyone wants to know that you're a long-term investor, you're sticking with the company. So, you know, probably the thing I'd take away from that is that you're definitely showing us that you're sticking with, you know, the companies you're backing. Randy, it's been a pleasure meeting you in person in London. Hopefully we can do it again.
And next time we talk, I'm pretty sure it's going to be a lot of the same names and a lot of the same strategy, because that is the importance of active management consistency over time.
Thank you very much for coming on Vantage, Randy.
I appreciate it.